There's a number that should terrify every economist on earth. $77.89 in Shanghai, $72.23 in New York. The same metal, the same day, two prices separated by $5.66. In a functioning market, that gap closes in seconds. On December 24, 2025, it didn't close. It widened because the metal in New York is imaginary and the metal in Shanghai is real. The greatest arbitrage opportunity in history just proved the West has been trading air for 50 years, and the system that built the dollar's dominance died overnight. By the end of this investigation, you'll understand three things. First, how a $5.66 price gap exposed the greatest fraud in financial history. Second, why industrial giants are paying 7% premiums to secure metal that's supposed to be abundant. And third, why the institution that has controlled commodity pricing since 1975 just lost that authority forever. Not gradually, but in 48 hours on Christmas Eve. Let's start with what happened at 3:30 a.m. when the West was asleep. December 24, 2025. 3:30 a.m. Eastern Standard Time. New York is dark. London markets are closed for Christmas Eve. The financial world is on holiday mode. And in that silence, the Shanghai Gold Exchange opened for trading with a price that should be impossible. Silver, $77.89 per ounce. At the exact same moment, COMEX in New York, the exchange that has set global silver prices for 50 years, showed $72.23 per ounce. Same metal, same minute, two prices, $5.66 apart. In commodities trading, price discrepancies of 10 cents trigger immediate arbitrage. Algorithms detect the gap in milliseconds. Banks execute thousands of contracts to capture the spread. The market corrects itself automatically. A $5 petit fox gap represents 7.8% profit, risk-free, instant. That's not a trading opportunity. That's a mathematical certainty. Banks would mobilize billions to close that gap. High-frequency trading firms would execute within nanoseconds. But on December 24th, nothing happened. The gap didn't close. It expanded. By 4 p.m., Shanghai hit $78. New York remained at $72.23. The spread reached $5.89. By 6 a.m., $79.03 in Shanghai, $72.23 in New York, $6.80 spread. Every trader on earth could see it. The arbitrage opportunity of the century was sitting there, visible, quantifiable, guaranteed profit. And no one touched it. Why? Because arbitrage requires one thing: the ability to actually execute both sides of the trade. Buy in the cheap market, sell in the expensive market, capture the difference. But COMEX silver at $72.23 isn't real silver. It's a paper contract, a promise of future delivery. And when traders tried to convert those paper contracts into physical metal to ship to Shanghai, they discovered something catastrophic. There is no metal. The registered inventory, the portion of COMEX silver that's actually available for delivery, stood at 37.6 million ounces on December 23rd. By December 24th evening, it had dropped to 34.1 million ounces, 3.5 million ounces withdrawn in 24 hours. That's 9.3% of deliverable supply gone. And the price gap kept widening because the market had just learned a truth that destroys the entire pricing system. New York doesn't have the metal it claims to be selling. Shanghai does. And Shanghai is no longer accepting New York's imaginary prices. This is decoupling, not the gradual shift analysts predicted over decades. The instantaneous recognition that the paper market and the physical market are no longer connected. And once that connection breaks, it doesn't reconnect. The system that allowed the West to dictate commodity prices to the world just ended. Not in 2030, not next year. On Christmas Eve 2025, while America slept, let's break down why the most obvious trade in history didn't execute, because understanding this mechanism reveals how the entire commodity system has been operating on a lie. Arbitrage is the foundation of efficient markets. If gold is $2,000 in London and $2,010 in New York, traders buy in London, sell in New York, pocket $10 per ounce. This happens millions of times per day across every commodity, every currency, every tradable asset. It's automatic. It's mechanical. It keeps global prices synchronized. The 566 silver gap should have triggered the largest arbitrage operation in commodities history. Here's how it should have worked. Step 1. A bank buys 1 million ounces of silver on COMEX at $72.23. Cost, $72.23 million. Step 2. The bank takes delivery of physical metal from COMEX warehouses. Step 3. The bank ships the metal to Shanghai. Step 4. The bank sells 1 million ounces on the Shanghai Gold Exchange at $77.89. Revenue, $77.89 million. Step 5. Profit, $566 million, minus shipping and insurance, maybe $5.4 million net. On a $72 million position, that's 7.5% profit in a week. Annualized, that's over 400% return. Risk-free. Guaranteed. Every major bank on earth has teams whose only job is to identify and execute exactly this kind of trade. J.P. Morgan, HSBC, Goldman Sachs, they have the infrastructure, the capital, the expertise. This is what they do. And on December 24th, not one of them executed the trade. Why? Step 2 failed. Taking delivery of physical metal from COMEX. When a trader buys a COMEX silver contract, they're buying the right to receive 5,000 ounces of silver at a future date. Most contracts are never converted to physical delivery. They're settled in cash. Traders speculate on price movements, close positions, take profits or losses, and move on. Less than 1% of COMEX contracts result in actual metal delivery, but the system only works if physical delivery is theoretically possible. If a trader demands delivery, the metal must be available. That's the foundation. COMEX prices represent real metal because you can, if you choose, demand the metal. On December 24th, traders chose to demand the metal, and COMEX couldn't deliver. Here's what actually happened. J.P. Morgan holds 8.2 million ounces of silver in COMEX warehouses. On December 23rd, 7.6 million ounces were classified as eligible, meaning owned by J.P. Morgan, but not available for delivery to contract holders. Only 600,000 ounces were registered, available for delivery. By December 24th of evening, the registered inventory dropped to zero. 600,000 ounces withdrawn. J.P. Morgan silver gone. Asahi Refining, one of the largest precious metals refiners in North America, held 2.1 million ounces in COMEX warehouses on December 23rd. 1.4 million registered, available for delivery. By December 24th evening, 1.4 million ounces withdrawn. Asahi's deliverable silver gone. Across all COMEX warehouses, registered silver dropped from 37.6 million ounces to 34.1 million ounces in 24 hours, the fastest withdrawal rate in COMEX history. And this is why arbitrage didn't happen. Because the traders who tried to execute Step 2, take delivery of physical metal, were told, "We don't have it." Some were offered cash settlement at COMEX prices instead of metal. Some were told delivery would be delayed by weeks or months. Some were told they could take eligible inventory if they paid a premium above the contract price. The message was clear. The metal you bought doesn't exist. The contract you hold is not backed by physical silver. The price you see on the screen is not connected to reality, and in that moment, the entire commodities pricing system broke. Because if COMEX can't deliver metal at COMEX prices, then COMEX prices are fiction. And if COMEX prices are fiction, then the only real price is the price where physical metal actually trades, Shanghai. The decoupling wasn't a market event. It was a revelation. The West has been setting prices for commodities it doesn't have. And the East just stopped pretending those prices matter. While the arbitrage failure exposed the paper fraud, another indicator confirmed the crisis had moved beyond financial markets into the real economy, backwardation. In normal commodity markets, future prices are higher than spot prices. This is called contango. It exists because storing a commodity costs money. If you buy gold today, you have to pay for a vault. If you buy oil, you need a tank. If you buy silver, you need secure storage. Those costs are priced into futures contracts. Gold for delivery in 12 months should cost more than gold for delivery today because someone has to store it for 12 months. This is how commodity markets have functioned for a century. Contango is the default state. When contango inverts, when spot prices become higher than future prices, the market is in backwardation. And backwardation means something catastrophic. The market believes the commodity is scarcer today than it will be in the future. Backwardation rarely occurs in precious metals. Gold has been in backwardation exactly 4 times in the last 50 years, each time for less than 48 hours during extreme financial crises. Silver backwardation is even rarer. The last sustained silver backwardation was during the 2008 financial collapse when industrial production halted globally. On December 24, 2025, silver entered backwardation at 7.18%. That means the market is willing to pay 7.18% more for silver delivered today than for silver delivered in 12 months. In monetary terms, traders are offering $7.89 for immediate delivery and $72.50 for delivery next December. This is mathematical insanity under normal conditions. Why would anyone pay 7% extra to receive metal today instead of waiting a year? Storage costs are less than 1% annually. The rational choice is to buy the cheaper future contract, wait, take delivery later, and pocket the difference. But December 24th wasn't normal. And the entities paying this 7% premium weren't speculators. They were industrial manufacturers, the companies that actually use silver in production. Silver is not just a monetary metal. It's an industrial necessity. Every smartphone contains 0.3 grams. Every electric vehicle contains 30 grams. Every solar panel requires 20 grams. Tesla, Samsung, First Solar, Canadian Solar, they all need continuous silver supply to keep production lines running. And on December 24th, industrial buyers panicked. Here's why. Solar panel manufacturers source silver on 90-day supply contracts. They order in advance, lock in prices, plan production around guaranteed delivery. In normal markets, this works. Suppliers deliver on schedule. Prices fluctuate, but supply remains stable. But when COMEX announced delivery delays and Shanghai prices spiked 8% above New York, industrial buyers realized their supply chain was collapsing. If COMEX can't deliver to banks, it can't deliver to manufacturers. If Shanghai is the only market with physical metal, then Western manufacturers dependent on COMEX supply are about to face production halts. Tesla's Gigafactory in Texas uses 40 million ounces of silver annually for electrical components. A 30-day supply disruption would halt production of 125,000 vehicles. Lost revenue, $6.2 billion. First Solar's Ohio facility uses 18 million ounces annually. A 60-day disruption would cost $890 million in lost panel sales. These aren't financial speculators worried about portfolio values. These are manufacturers facing existential supply risk. And when manufacturers panic, they don't care about price. They pay whatever it takes to secure physical inventory because production halt losses dwarf commodity costs. That's what the 7.18% backwardation represents. Industrial buyers offering $77.89 for immediate silver, while futures trade at $72.50, because they believe silver available today will not be available tomorrow. They're not speculating on price appreciation, they're buying survival inventory. And here's what makes this terminal for the paper system. Once industrial buyers bypass COMEX and source directly from Shanghai, they never come back, because COMEX just proved it can't guarantee supply. A manufacturer that nearly halted production because COMEX failed to deliver will never again trust COMEX as a primary supplier. The backwardation isn't a temporary dislocation. It's industrial capital voting with billions of dollars that the paper market is finished. The real price is in Shanghai. The real metal is in Shanghai. And COMEX is now irrelevant. While Shanghai prices surged and backwardation signaled industrial panic, physical silver was vanishing from Western vaults at a rate that confirms this isn't a market correction. It's a bank run. COMEX operates through a network of approved warehouses. These facilities store silver on behalf of banks, refiners, and institutional holders. The inventory is divided into two categories. Eligible, silver stored in COMEX warehouses, but not available for delivery against futures contracts. This is metal owned by banks or institutions held in COMEX facilities for safekeeping. Registered, silver available for delivery to futures contract holders. This is the metal backing COMEX contracts. When a trader demands physical delivery, it comes from registered inventory. The distinction is critical. Eligible inventory can become registered if the owner decides to make it available for contract delivery. But until that happens, eligible silver is effectively off-market. It's stored at COMEX, but can't be delivered to contract holders. Total COMEX silver inventory on December 23rd, 287.4 million ounces. Registered, deliverable, 37.6 million ounces. Eligible, not deliverable, 249.8 million ounces. That means only 13% of COMEX inventory was actually available to back futures contracts. The other 87% was stored there but couldn't be delivered. On December 24th, the registered inventory collapsed. By December 25th, 34.1 million ounces registered. Withdrawn in 48 hours, 3.5 million ounces. That's the second fastest drawdown in COMEX history, exceeded only by the March 2020 COVID panic when 4.1 million ounces were withdrawn in 72 hours. But here's the difference. In March 2020, prices spiked. Industrial buyers rushed to secure inventory, and within 2 weeks, the withdrawals stopped. Supply stabilized. Registered inventory rebuilt. In December 2025, the withdrawals didn't stop, and they weren't being replaced. Normally, when registered inventory drops, owners of eligible inventory convert it to registered to capture the price premium. If demand is high, making silver available for delivery becomes profitable. The system self-corrects, but on December 24th, eligible inventory was also dropping. JP Morgan's eligible inventory, 7.6 million ounces on December 23rd, 6.9 million ounces on December 25th, 700,000 ounces withdrawn. Brink's eligible inventory, 12.3 million ounces on December 23rd, 11.1 million ounces on December 25th, 1.2 million ounces withdrawn. Asahi Refining eligible inventory, 1.8 million ounces on December 23rd, 400,000 ounces on December 25th, 1.4 million ounces withdrawn. Total eligible withdrawals in 48 hours, 3.3 million ounces. This is unprecedented. Registered inventory dropped by 3.5 million ounces, and instead of eligible inventory converting to replace it, eligible inventory also dropped by 3.3 million ounces. 6.8 million ounces total withdrawn from COMEX in 48 hours. That's 2.4% of total inventory, 18% of registered inventory gone. Where did it go? Some went to industrial manufacturers securing panic inventory. Some went to Shanghai, sold at the $77.89 premium. But most went into private vaults, withdrawn by institutions that no longer trust COMEX to manage custody. This is a confidence crisis. The entities that store silver at COMEX, JP Morgan, HSBC, Asahi, Brink's, are simultaneously the largest silver traders on Earth. They use COMEX warehouses because it's efficient for trading. Metal stored at COMEX can be pledged, borrowed, delivered against contracts without physical movement. It's the infrastructure that makes COMEX function. When those entities withdraw metal from COMEX, they're signaling they no longer believe COMEX custody is safe. They'd rather pay for private vaults and shipping than leave silver in a system that just failed to deliver. And once that metal leaves COMEX, it doesn't come back. Because the institutions withdrawing it are the same institutions that would normally replenish inventory. When JP Morgan removes silver from COMEX, there's no larger entity to replace it. JP Morgan is the largest. This is the vault exodus. The infrastructure that allowed COMEX to set global prices, centralized inventory managed by trusted institutions, is disintegrating. The metal is scattering into private storage. The system is fragmenting. And once fragmentation begins, price discovery becomes impossible. Because COMEX prices were only credible when COMEX controlled the inventory. Now Shanghai controls the inventory, and Shanghai sets the price. COMEX has set global silver prices since 1975. For 50 years, the price of silver announced in New York was the price accepted worldwide. Miners sold at COMEX prices. Manufacturers bought at COMEX prices. Central banks valued reserves at COMEX prices. This wasn't arbitrary. COMEX earned price authority through liquidity and deliverability. If you wanted to buy 10 million ounces of silver, COMEX could facilitate the trade and deliver the metal. That made COMEX the reference point. But on December 24th, COMEX lost deliverability. And when a commodity exchange can't deliver the commodity, it loses price authority. Here's the mechanism that built COMEX dominance and why it just collapsed. COMEX allows leverage. This creates massive liquidity. On a typical day, COMEX trades 150 million ounces of silver. Total annual silver mine production, 820 million ounces. COMEX trades 18% of annual global production every single day, almost entirely on leverage. That liquidity made COMEX the global price reference. If you needed to know the real-time value of silver, you looked at COMEX because that's where the volume was. But here's the hidden truth. That 150 million ounces of daily trading volume isn't backed by 150 million ounces of physical silver. It's backed by 37.6 million ounces of registered inventory. The rest is leverage, paper contracts representing metal that doesn't exist in deliverable form. The system works as long as less than 25% of contract holders demand physical delivery. COMEX can deliver 37.6 million ounces. If 150 million ounces trade daily and only 10 million ounces are demanded for delivery weekly, the system functions. The leverage ratios remain stable. But if a significant percentage of contract holders simultaneously demand delivery, the system collapses instantly because there isn't enough metal to cover the paper claims. This is fractional reserve banking applied to commodities. COMEX operates on the assumption that most contracts will be cash settled, that traders speculate on price but never take possession, and that assumption held for 50 years. Until December 24th, when industrial buyers and arbitrage traders simultaneously attempted to take delivery, and COMEX couldn't fulfill. The failure wasn't just operational, it was mathematical. COMEX has 37.6 million ounces available. December 24th saw delivery demands exceeding 8 million ounces in 24 hours. If that rate continued for 1 week, 56 million ounces would be demanded. COMEX would be insolvent in 5 days. To prevent insolvency, COMEX did what every fractional system does when facing a run. It stopped honoring withdrawals. Some traders were offered cash settlement instead of metal. Some were told deliveries would be delayed by 4 to 6 weeks. Some were offered eligible inventory at a 12% premium above contract prices. These are bank run tactics. When a bank can't honor withdrawals, it limits withdrawals, delays payments, and offers alternatives. The goal is to prevent panic while buying time to source liquidity. But COMEX isn't a bank with access to Federal Reserve lending. It's a commodity exchange. And the commodity it trades is finite. There is no silver printing press. If the metal isn't in the vaults, it doesn't exist. And here's the terminal problem. Even if COMEX sources additional inventory over the next weeks, the damage is done. Industrial buyers now know COMEX can't guarantee delivery. Arbitrage traders know COMEX prices don't reflect physical availability. The credibility that made COMEX the global reference is destroyed. Shanghai, meanwhile, delivered every ounce demanded on December 24th. Prices were higher, but delivery was instant. No delays, no cash settlements, no excuses. You paid 70 CIB, 89, you got your silver. That's how price authority transfers, not through regulation or agreement, but through revealed preference. When the market learns that Shanghai delivers and COMEX doesn't, Shanghai becomes the reference price, automatically, irreversibly. COMEX will still exist. It will still trade contracts, but its prices will no longer set global benchmarks. There'll be regional quotes relevant only to traders willing to accept cash settlement and paper exposure. The real price, the price that matters to anyone who needs physical silver, is now in Shanghai. And it's $77.89, not $72.23. The paper empire didn't fall in a dramatic crash. It fell in a quiet recognition. The metal you're trading doesn't exist. And once that's understood, the system is finished. What happened on December 24th, 2025, is larger than silver. It's the mechanism through which the West has controlled commodity pricing since the Bretton Woods collapse in 1971, being exposed as a fraud. For 50 years, Western exchanges, COMEX, LME, ICE, have set global prices for metals, energy, and agricultural goods. Those prices were accepted worldwide because Western financial systems controlled liquidity and delivery infrastructure. But that control depended on one condition. The West had to be able to deliver physical commodities at the prices it quoted. As long as delivery was possible, Western prices remained authoritative. The moment delivery becomes impossible, price authority transfers to whoever can deliver. And on December 24th, that authority transferred to Shanghai. This has immediate consequences across every commodity. Gold, if silver decouples, gold follows. The same paper leverage system that failed in silver exists in gold. COMEX holds 8.7 million ounces of registered gold backing contracts, representing far more. If traders demand delivery, COMEX faces the same insolvency. Shanghai Gold Exchange already trades higher volumes than COMEX in physical gold. The decoupling is already underway. Copper, essential for electrical infrastructure, electric vehicles, and renewable energy. China controls 50% of global refined copper production and 40% of global demand. If Shanghai copper prices decouple from LME prices, Western manufacturers lose access to reliable supply at predictable costs. Lithium, critical for battery production. China controls 77% of global lithium refining capacity. Western prices are already increasingly irrelevant. Tesla and other EV manufacturers source directly from Chinese refiners at Shanghai prices, not LME quotes. Oil. The petrodollar system requires oil to be priced in dollars. But if Saudi Arabia, UAE, and other OPEC members begin accepting yuan for oil, as Saudi Arabia has since 2023 in limited contracts, the pricing authority shifts. Brent and WTI remain relevant for Western markets, but the global benchmark moves to Shanghai. The pattern is identical. If the West cannot deliver physical commodities at quoted prices, price authority transfers to the East, which can. And here's the structural reason this is irreversible. China is the world's largest consumer of nearly every industrial commodity, largest consumer of copper, aluminum, nickel, rare earths, and silver, second largest consumer of oil after the United States. When the largest consumer sets prices, suppliers follow. Miners and refiners will sell to whoever pays the most. If Shanghai pays $77.89 for silver and COMEX offers $72.23 but can't deliver, miners ship to Shanghai. Supply flows to the highest bidder with the ability to pay and take delivery. This is economic gravity. And on December 24th, the West lost the mass necessary to maintain gravitational pull. The financial implications are equally severe. The dollar's role as global reserve currency depended on commodity pricing in dollars. If oil, gold, copper, and other essentials begin pricing in yuan or other currencies, dollar demand declines. Foreign central banks holding dollar reserves need fewer dollars. The demand that has absorbed 50 years of dollar printing begins to reverse. And when that reversal begins, the dollars held overseas, estimated at $7 trillion in physical currency and $25 trillion in Treasury securities, start returning home, not because anyone decides to dump dollars, but because they're no longer needed for commodity purchases. This is the nightmare scenario the Federal Reserve has feared since 1971, the end of dollar dominance not through collapse, but through obsolescence. The world stops using dollars because the things dollars buy are now priced in other currencies. December 24, 2025 might be remembered as the day that process became irreversible, not because of a policy change or a war, but because COMEX couldn't deliver silver at the price it claimed silver was worth. The system that has controlled commodity pricing for 50 years just admitted it's been operating on leverage and promises, and the East called the bluff. On Christmas morning 2025, while families opened presents and celebrated, the financial world woke to a system that no longer functions. Shanghai silver, $79.12 per ounce. COMEX silver, $72.23 per ounce. The gap, $6.89 widening. Arbitrage, still impossible. Backwardation, 7 to 18%, sustained. COMEX inventory withdrawals, continuing. This isn't a market dislocation waiting for a correction. This is the market correcting a 50-year dislocation. The price in New York was always fiction. The price in Shanghai is reality, and reality just won. For those holding physical silver, the implications are clear. Your asset is repricing to Shanghai levels, not COMEX quotes. The 77 to 79 range is the new floor because that's where physical metal actually trades. For those holding COMEX paper contracts, the implications are catastrophic. You own a promise to deliver metal that doesn't exist from an exchange that just proved it can't fulfill delivery, priced at levels that no longer reflect physical markets. For industrial manufacturers dependent on silver, the implications are operational. Your supply chain's just fragmented. Prices are rising. Availability is uncertain. and the exchange you relied on for 50 years is no longer reliable. And for the dollar-based financial system, the implications are existential. The mechanism that made dollar commodity pricing authoritative just failed. The confidence that has sustained dollar dominance is eroding, and the process is accelerating. 3 questions for you. If COMEX can't deliver silver at $72, what other commodities are mispriced? If Shanghai now sets the real price for silver, how long until it sets the real price for gold, copper, and oil? And if the West has been trading paper promises for 50 years, what happens when the East demands physical settlement across every commodity market? Leave your answer in the comments because this conversation isn't theoretical anymore. It's happening right now, and the next 90 days will determine whether the system can adapt or whether December the 24th, 2025 was the day the West's commodity pricing authority ended permanently. If this investigation showed you something the financial media won't explain, subscribe. Because the decoupling that started in silver is spreading to every commodity market, and understanding the pattern determines whether you're positioned for the repricing or caught holding paper when the system demands physical. The West traded air for 50 years and called it price discovery. The East just stopped accepting air as payment, and the reckoning is here.